Welcome to the Deep Dive. You're here because you want the crucial insights from major earnings calls, fast. Today, we're digging into Brown & Brown, ticker BRO, and their Q3 2025 call.
Yeah, and this one's a bit of a head-scratcher.
Exactly. Our mission today is figuring out how a company posts what looks like a fantastic quarter, a real beat, and then the stock drops pretty hard the next day, over 6%.
It doesn't immediately add up, does it? Let's just run through those top-line numbers that everyone saw first.
Okay, let's do it.
All right, so non-GAAP diluted EPS, earnings per share, that hit $1.05. That's up over 15% from last year.
And well above what analysts expected, right? Like a 15-cent beat.
Yeah, a solid beat on the bottom line. And then you look at revenue. Total revenue surged to $1.606 billion.
Whoa, okay. How much up is that year over year?
That's up 35.4%. Again, beating the street's estimates by, 6, maybe 7%? Huge numbers.
And their adjusted profit metric, EBITDAC.
Adjusted EBITDAC, right. That hit $587 million. Up almost 42% year over year. And importantly, the margin expanded. Adjusted EBITDAC margin up 170 basis points to 36.6%.
So purely on those numbers, it looks fantastic. A clean sweep, beat on earnings, beat on revenue, expanding margins.
Exactly. Should have been a great day for the stock.
But it wasn't. It closed down over 6% the next day, and on pretty significant volume, too. So that's the core question. What did the market find under the hood or in the guidance that it just really didn't like?
Right. And the first big piece of that puzzle is where that massive revenue growth came from.
It wasn't all organic, I take it.
Not even close. The main driver by far was the Accession acquisition finally closing. Remember, that was the huge $9.83 billion deal, bringing in risk strategies and 180.
Ah, right. When did that close again?
August 1st. So it was only in the result for 2 months of the quarter, August and September.
And how much revenue did that add just in those 2 months?
Accession contributed roughly $285 million in total revenue and, added over 5,000 new employees, or teammates as they call them.
Okay, so that explains the massive jump. The strategy makes sense, expand specialty and wholesale, find cross-selling opportunities. Management said integration's going fine.
Yeah, they expressed satisfaction, said revenues and synergies are tracking kind of where they expected. Those synergies, though, they're planned to be realized all the way out through 2028.
Right, so a longer-term project. But if the headline growth was mostly the acquisition, then the market must have immediately looked at the core business health, organic growth.
Exactly. That's where the concern really crept in.
And what was the overall organic number?
It was 3.5%, which, is positive growth, but it's definitely a slowdown compared to recent quarters.
3.5%. And how did that break down by segment? Retail is usually the bellwether.
It is. And retail organic growth was only 2.7%.
Oof. Only 2.7%. Did they give a reason for that softness?
They did offer an explanation. Management pointed out that number included about a 1% headwind. It was related to some negative adjustments for employee benefits incentives.
A 1% headwind from incentives. Like a reversal of something positive from last year.
Essentially, yeah.
Yeah. A
reversal from a positive true-up they had in 2024. So they're saying the underlying might be closer to 3.7%, but still.
Still feels a bit light, maybe. Especially given the pricing environment in insurance right now. And what about the specialty distribution segment? That's where Accession plays. That should be strong.
Well, it was better than retail, but maybe not as strong as you'd think. Organic growth there was 4.6%.
Okay, 4.6%. What drove that?
It was a mixed bag. They saw good growth, high single digits, in their wholesale brokerage business. That's positive. But it was offset by continued pressure in programs related to wind and earthquake risk.
The catastrophe property market. Rates have been coming down there, haven't they?
Yeah, commercial cap property rates are still seeing downward pressure. That acted as a drag on the specialty segment's organic growth.
Okay, so organic growth overall was maybe a bit disappointing. What about the margin quality? That big jump in adjusted EBITDAC margin, was that all core operational improvement?
Not entirely. There was a bit of a temporary boost in there.
From what?
About $29 million came from incremental investment income. Basically, high yields they earned on the cash they raised back in June for the Accession deal before they actually spent it.
So earning interest on the M&A war chest. A temporary tailwind.
Exactly. And if you flip the coin and look at the GAAP numbers, the picture gets much messier.
The GAAP numbers include all the acquisition costs and accounting impacts. What did those show?
Significant margin compression. The GAAP income before tax margin dropped pretty sharply from 26.7% last year down to 19.4% this quarter.
Wow, quite a drop. What caused that?
Primarily two big things. Heavy amortization expense related to the acquired assets from Accession, and around $50 million in integration costs. The actual cost of merging these huge businesses.
Plus, wasn't there a non-cash charge too?
Yeah, an $8 million non-cash mark-to-market charge related to some stock liability. So the GAAP results really show the immediate financial weight of this massive integration.
Okay, so we have acquisition-boosted headlines, softer organic growth underneath, and messy JAP margins due to the deal costs. That really sets the scene for why the forward guidance might have spooked investors.
Absolutely. Even some positive signals on leadership and capital couldn't outweigh the outlook.
Let's touch on those positive signals first. Any notable changes?
Yeah, a couple. They appointed Steve Hearn as the new president of retail. He brings a lot of industry experience, which seems important given the focus on retail's organic growth.
And they also addressed Barrett Brown taking a personal leave.
They did handle it professionally on the call. And then, the big capital signals.
Right, the dividend and the buyback. What did they announce?
Textbook confidence moves. They raised the dividend by 10%. That's the 32nd year in a row they've increased it.
Wow, 32 years. Consistent.
Very. And they also authorized a brand new share buyback program for $1.25 billion.
Okay, that's a significant authorization. Signals they think the stock might be cheap.
Or at least that they have immense confidence in their cash flow. They highlighted generating $1 billion in cash flow from operations just year to date. So they're signaling we can handle the Accession debt and still return capital.
But even with that dividend hike and buyback, the stock still fell hard. So it must come down to the Q4 guidance. What did they say?
The guidance, especially for organic growth, was the real kicker. For the retail segment, they expect Q4 organic growth to be pretty similar to Q3. So around that 2.7% mark again.
Why so low again? Still the incentive headwind.
Yeah, continued headwind from those incentive adjustments. Plus, they mentioned a tough comparison because they wrote some multi-year policy revenue back in Q4 of last year that won't repeat. So more sluggishness expected in retail.
Okay, not great, but maybe expected after Q3. What about specialty distribution? That's the growth engine, right?
That's where the guidance got really concerning for the market. They anticipate the organic growth rate for specialty distribution could actually decline in Q4.
Decline. Negative organic growth.
Yeah, potentially falling into the mid-single-digit range. Negative.
Ouch. Why such a sharp turnaround?
It's kind of a perfect storm of headwinds hitting all at once in Q4. First, a really tough comparison against Q4 last year when they had $28 million in non-recurring revenue from processing flood claims.
Okay, so taking out that one-off makes the comparison hard. What else?
Continued rate pressure in that commercial cat property space we talked about. And also, they're expecting slower growth in their lender-placed business. Put it all together, and you get a forecast for negative organic growth.
And the market hates negative organic growth, even if there are understandable reasons like tough comps.
Absolutely. It raises questions about the underlying momentum.
Did they give any color on the broader insurance market trends they're seeing?
They did. Some useful context there. Commercial insurance pricing overall for admitted P&C seems pretty stable. Think flat to maybe up 5%.
But what about the problem areas like casualty and auto?
Still seeing significant rate increases there. They mentioned 5–10% hikes, likely for primary layers, and even higher increases for excess layers.
Driven by?
Largely by rising claims costs and what they see as a need for tort reform to address those huge jury verdicts.
And the E&S market, the excess and surplus space where Accession plays heavily, are the standard carriers pushing back in?
Management acknowledged that narrative is out there, admitted carriers getting more competitive, but they still firmly believe the E&S market growth will continue to outpace any shift back towards admitted carriers, basically validating the Accession strategy long term.
And one last point before we get to the trade idea, what about the debt from the acquisition? Any update on paying that down?
Yeah, they reiterated their plan. They expect to get their gross debt leverage back into their target range, which is 0 to 3 times EBITDA within the next 12 to 18 months.
That seems pretty quick given the size of the deal.
It is aggressive, yeah. Shows strong confidence in their cash flow conversion to pay down that debt rapidly.
Okay, that's a lot to digest. Inorganic boost, organic slump, integration costs, tough Q4 guidance, but strong cash flow and capital return signals. Let's pivot to our segment. This is not financial advice. We take all this data and cook up one, let's say, bold but potentially plausible trade idea.
All right, let's pitch it. The core idea here is that the market is overreacting to the short-term noise, the organic slowdown, the integration costs. It's punishing the stock for transition risk.
But the underlying thesis is that the Accession deal was strategically sound and the company's a cash machine.
Exactly. So this is really a bet on management's ability to execute on the integration and get that organic growth engine firing again eventually. It requires some patience.
So what's the trade structure? Just buy the stock?
Not quite that simple, because we know Q4 is likely to be weak, maybe even negative on the organic front as guided. So we propose what we'll call a high conviction execution long. You go long the BRO stock, yes, buy the shares.
Right.
But you protect yourself against that near-term weakness and volatility by selling a medium-term covered call against the position.
Okay, so selling someone else the right to buy your shares later at a higher price and collecting income or premium for selling that right now.
Precisely. You choose a strike price that's comfortably above where the stock was trading before this earnings drop, maybe somewhere around, say, $88 or $90, and you pick an expiration date maybe 6 to 9 months out.
So you pocket that premium now, which provides a cushion if the stock chops around or dips further after the Q4 results.
Exactly right. It helps you ride out the expected turbulence. The bet is that over the next 12 to 18 months, as Accession gets integrated, synergies start to show, and they hit that deleveraging target, the market will look past the current organic slump, and the stock will recover and move higher. The call premium just helps you get paid while you wait.
Makes sense. What's the absolute biggest risk to that trade? What kills it?
The risk is that the organic slowdown, especially in that core retail segment, isn't just temporary. It's not just tough comps or one-off adjustments, but it's actually a structural issue. Maybe they're losing share, or the market dynamics are worse than they think.
And if that organic growth stays stuck below, say, 3% for multiple quarters,
Then the narrative flips. The Accession deal starts to look too expensive relative to a stagnating core business. The deleveraging might take longer, and the stock's valuation multiple could stay compressed or even fall further. The covered call helps, but it won't save you from a fundamental thesis break.
got it.
Yeah.
It's a bet on execution and the temporary nature of the headwinds.
That's the essence of it. Buy the dip, manage the near-term risk with the call, and bet on management delivering over the medium term.
Okay, let's wrap this up. To synthesize, Q3 for Brown & Brown was really a tale of two conflicting stories, wasn't it?
Absolutely. You had the massive inorganic lift and the powerful cash flow generation from this Accession deal. Big positive numbers there.
Butting right up against clear deceleration in the core organic business and, pretty significant near-term margin pressure from all the costs of actually integrating that huge acquisition.
And facing that difficult Q4 outlook, management clearly decided to use strong capital allocation, signals the dividend hike, that big buyback, as a way to try and reassure investors.
Which brings us to our final thought for you, the listener. Think about the timing here. The stock sells off hard on fears about organic growth and integration risk. And right at that moment, management announces a new $1.25 billion buyback.
So the question is, do they genuinely see this lower price as a fantastic opportunity, a true arbitrage, to snap up shares they believe are deeply undervalued?
Or was announcing that buyback right then more of a strategic necessity? A costly but required signal to try and put a floor under the stock and stabilize confidence while they navigate this tricky transition period. Analyze that timing. What does it really tell you about their own view versus the market's?
Something to chew on. Thanks for joining us for this deep dive.